how to take advantage of the Mega Backdoor Roth in the Shell 401k, the Provident Fund. So a lot of people we see at Shell when they come in and meet with us for the first time are taking advantage of the $23,000. So if you're under age 50 in the 2024 year, you can contribute $23,000 pre-tax or Roth into the Provident Fund, the 401k at Shell. What a lot of people don't know is that the federal limit of contributions from all sources to a 401k for the 2024 year is $69,000. Well, Shell's max contribution is $34,500. How do we get to the $34,500? The max income Shell can look at in a given year is $345,000. That's set by the IRS as an income limitation. The max benefit, if you've been at Shell 10 years, they'll contribute 10% of your compensation into the 401k. And then we take the 69, subtract out Shell's contribution, max contribution, subtract out your max contribution, either pre-tax or Roth, and we get $11,500. Most people are not aware that you can contribute additional after-tax money to the 401k, and there's a benefit for it. Or they contribute after-tax money to the 401k and they don't roll it out. One of the things we want to be doing annually, and we help our clients do when we meet with them, review contributions, adjust limits, is contribute the $11,500 annually to the after-tax source over and above the $23,000 that you can put in and roll it out to a Roth. And there's a big reason we want to roll it out to the Roth, so we get tax-free growth. We don't get tax-free growth if we leave the money in the Provident Fund. Now, with Shell's contribution page, there's a split between base contribution, right, your base pay, and bonus contribution. And you want to make sure either you're pre-tax or Roth, you're hitting your $23,000 between base and bonus. Additionally, if you've got the cash flow for it, you want to be contributing after-tax money either through the base or the bonus into the Provident Fund. And this is often what a lot of people miss. You have to make those different elections. Then you want to roll it out. Now, one of the questions we often get is, well, okay, I can contribute an additional $11,500 into after-tax, roll it out to the Roth, but why don't I just save that money in my taxable account? It's more accessible. Or my joint account at Fidelity. Why don't I just save the money there and invest it? The reason is tax drag. In your taxable account, if you earn interest, you got to pay taxes immediately. And at your ordinary income rates, which can be as high as 37%. And if you make over $250,000 a year, you got to pay an additional 3.8% Medicare surtax on investment income. So you can end up paying over 40% tax rate on interest. On dividends, that's more beneficial rate. Dividends and long-term capital gains get preferential tax rates, but you can end up paying 23.8% on dividends and long-term capital gains. Whereas with Roths, you never pay taxes. The interest comes out, the interest grows tax-free, dividends grow tax-free, capital gains are tax-free, and if you've had a Roth for 5 years, the total sum of the contributions in your Roth can come out prior to 59.5 without a tax penalty. So there's a lot less tax drag on Roth accounts, and that's why we think it's a huge advantage to make sure you are doing the Mega Backdoor Roth at Shell each and every year. If you found this valuable, make sure to subscribe to our YouTube channel for educational content for Shell professionals.